Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA Nrajca, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice, had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executive. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar.
What is the treatment of trade receivables from related parties while arriving at the drawing power? So this is mainly with reference to cash credit facility. So for cash credit facility, disbursement will happen only on the basis of this drawing power, and this drawing power will be mainly calculated on inventory and receivable. Inventory, of course, it is with them, but receivables are basically money that have to be collected from customers. So here the question is, what will happen if those customers' trade receivables are actually related parties? Let's see. In normal case, while computing the drawing power, what the bank will do? They'll take the debtors, from that they will deduct the margin, okay? Then they will arrive at the advance value. And while considering the debtors, they will consider only those debtors that are within the cover period. Cover period is basically the credit period which are extended by that borrower to their customer, and that is what considered in the loan assessment. Okay, so if they are giving on an average credit period of 45 days, only that 45 to 60 days of debtors will be considered for arriving at the drawing power. Okay, that is the background. Now listen, in the normal case, debtors less margin advance value. This is how it will be done. But if it is from related party, then banks may have different approach, and possibility is this approach could vary bank to bank. There are banks which are very conservative. There are banks which are ready to take risk. Conservative bank will say straight no to receivables from related parties. They will say straight no, we cannot fund receivables related to related parties. They have to be altogether excluded while computing the drawing power. And other banks will say we will consider on case-to-case basis. But why they are saying like this? Let's see. Look at this scenario. A Limited and B Limited, they are basically related parties. Now, A Limited is going to sell some goods to B Limited. It is possible amongst related parties, sales can happen. Genuine sales can happen. Inflated sales can happen. And artificial sales also can happen. That is without any goods or services. Let's see all those. So here A Limited and B Limited are related party. A Limited is selling some goods to B Limited. Normally they will sell it for 100 only. Okay, let it be 100 million. But since B Limited is a related party, and to take advantage of something, they are invoicing this 100 million as 150 million to B Limited. So what happened? A Limited normally 100 million, but since because they are selling it to B Limited, they have inflated it to 150 million. It means it is inflated by 50 million. Now what is the benefit of this inflated 50 million for A Limited? For A Limited, their sales will become 150 instead of 100, and as a result, their trade receivables will also increase, and as a result, the money what they can draw through cash credit will also increase. It is because they have artificially inflated. And this is one reason why bankers are concerned, because there is all possibility that when a transaction happens between related parties, some kind of manipulations will happen. And since bankers are not in a position to identify what is that exact manipulation, they'll say, no, we are not going to fund against related party receivable. Okay, that could be one reason. The other reason could be without any economic transaction taking place, they will artificially create invoice. Look at this case. A Limited is not having any goods, but it is raising invoice against B Limited, let's say for 150 million. No goods at all, no service at all. They are raising and it is still receivable only. And what this A Limited will do? It will present 150 million invoice in trade receivables and it will ask for funds with bank, cash credit. No economic transaction. This is 100% inflated invoice, artificially created invoice. So these kind of possibilities could also happen. In many of the NPS, many of the fraud cases, these kind of events have surfaced. And it's because of this reason as well, banks will say, no, we are not going to lend against related party transaction, related party receivables. But there are genuine cases which deserves funding, that too when they are amongst the related parties. Okay, if you take big groups and all, they'll be in various stages of their supply chain. Okay, and they have to sell to their group company only, A Limited to B Limited, B Limited to C Limited, then only it will get the final shape, and each of them require deserving credit facilities. Those are all genuine cases. On case-to-case basis, certain banks will agree, okay, we are ready to fund against related party, but it will be on a case-to-case basis, and we will also satisfy ourselves the genuineness of transaction. And another reason why sometimes banks are very reluctant for this related party receivables is when both the parties are having credit facility with the same bank. So let's say this is single bank, same bank. I'll call this as XYZ bank. Okay. So this XYZ bank has a customer called A Limited and B Limited. Now listen. This A Limited has raised an inflated invoice of 150 million, what we have seen earlier here, this one, this case. So already it is inflated by 50, okay. And this A Limited will present these datas. Let's say the margin is 40%, that is deducted, which is 60. 150 minus 60, you get 90, that is the advance value. I'm assuming the sanction limit is also same 90 lakhs or 90 million. So 90, whichever is lower, that is going to be the drawing power, and in this case this 90 million itself is drawing power. Here if you notice, already this 150 is inflated by 50. At that point itself, bank is at a huge risk. And the another risk for this bank is, the same bank has this related party also as a borrower. And what that B Limited, that is the related party, will do? They will show a stock of 150 as if they have purchased from A Limited. It may be the real purchase with inflated value, or it can be a dubious purchase also, right? So they will show stock of 150. Assuming on the stock margin is 25%, it works out to 37.5. So advance value is 112.5. And I am assuming the sanction amount is also equal to this. So advance value or sanction limit, whichever is lower, and in this case both are same. So DP is this 112.5. Now just imagine, look at the fate of this bank. Already they are at risk for having taken exposure on this balance 50. Okay, that itself is at risk. And number two is they are also going to fund this 150. Against this 150, they are going to give 112.5. When we are saying that already this is excess funding, here there is a double financing also. There is a double financing. And bankers may not be able to deduct this. That's the reason they are also reluctant for funding against trade receivables. So in general, banks will not give drawing power against related party receivables, but there are banks which will go on case-to-case basis, because in most of the sanction letter you will see trade receivables from related parties have to be excluded, and this is the reason for that.
Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2,000 rupees. But for you, I'm going to give you a special offer.
Here we go. Banking credit courses bundle. This includes Course number 1, Banking Credit Analysis Process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2, that is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis, and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like ad hoc credit facilities, letter of credit and all. So far I have introduced 7 courses of 1,999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, Collateral Securities, a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over, some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses, and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.